You have probably heard about the new $250 working Australians tax offset announced in the 2026-27 federal budget. A lot of people are already imagining $250 landing in their bank account like a little bonus. That is not how it works. WATO is a tax offset, not a handout. And if you treat it like cash, you'll be confused at tax time. But here is the loop I want to open. When you stack WATO with the other tax cuts arriving from 2026, a worker on average earnings could be up to $2,116 a year better off, according to Treasury. In the next few minutes, I will walk you through exactly what it means and the moves to actually grab that benefit. Let me set the stakes. From the 2027-28 income year, the $250 working Australians tax offset will provide an ongoing annual tax cut to over 13.3 million Australian workers, and budget commentary estimates around 97% of eligible workers will get the full $250 each year, according to Treasury. The risk of getting this wrong is not just confusion. If you assume it is a cash payment and adjust your budget or take on commitments, you will discover at tax time it is only a $250 reduction in your tax bill, not $250 in the bank. And the bigger cost is undervaluing the whole package. Miss that and you leave thousands of dollars of after-tax capacity invisible. Money that could be cutting your mortgage or building your super. Step 1. Understand the mechanism before you do anything else. A tax offset reduces the amount of tax you owe. It is not extra income and it is not a cash handout, according to Treasury explanatory material. WATO is designed to cancel $250 of tax that would otherwise be payable on the first slice of taxable income above the ordinary tax-free threshold. In plain terms, it effectively lifts the tax-free threshold for work income by about $1,785. Yes, from roughly $18,200 up to $19,985 or up to $24,985, where the low-income tax offset also applies, according to Budget 2026-27 analysis. It only applies to income from a job, wages, salary or net sole trader income from 1st July 2027. Get that straight first. Here's the number that matters more than the $250 itself. From 2027-28, the first $19,985 of your work income is effectively tax-free, up from about $18,200 according to Budget 2026-27 analysis. That is roughly $1,785 of income that becomes tax-free for someone in the 19% marginal bracket that is about $339 in tax avoided on that slice each year, on top of the $250 offset that eliminates the tax on it. The government describes this as the largest permanent increase to the effective tax-free threshold since 2012-13, so this is a rare change worth paying attention to. Move 1. Figure out your real number. Log into MyGov and link your ATO account. If you have not already, then open your most recent Notice of Assessment to see your current taxable income and tax paid. Next, open Treasury's Budget 2026-27 tax reform page and confirm that from 2027-28 you qualify as an eligible worker for the $250 WATO. That means employment or sole trader income. Then use the ATO's online tax calculator to model your tax under current rules versus projected 2027-28 rules including WATO, and write the dollar difference down. What good looks like. You can say in dollars how much less income tax you will pay per year. For average earners, that is up to about $2,116 a year across all the measures, according to Treasury. This is why the $250 framing undersells it. Treasury and budget papers explain that WATO builds on 3 already legislated tax cuts, plus a new $1,000 instant tax deduction starting in 2026-27. For a worker on average earnings, the government states the combined benefit of these 5 measures could be up to $2,116 per year from 2027-28, relative to 2023-24 tax settings, according to Treasury. So when you do your calculation in Step 2, you're not just hunting for $250, you are looking at the whole stack. That changes how you should think about budgeting, wage negotiations, and what you can afford. Move 2. Decide where the money goes before it disappears. Work out a realistic number between $250 and $2,800 a year that reflects your expected tax cut benefit, using the Treasury modelling as a guide if you're an average earner. Then pick one priority target. A mortgage offset account, a high-interest savings account, an extra help repayment, or extra super contributions. Now set up an automatic transfer or increase your salary sacrifice by that amount, broken into fortnightly or monthly installments timed with your pay. What good looks like? At least $250 a year, the WATO amount is automatically redirected to a specific goal and ideally closer to $2,000 a year if your combined benefit is near Treasury's up to 2,116th figure. Move 3. Do not leave the easy money on the table from 2026-27. There is a new $1,000 instant tax deduction that lets you claim up to $1,000 of work-related expenses without keeping detailed receipts. Log into ATO online via MyGov and review last year's work-related deductions to see what you claimed. Then read the ATO and budget guidance on the instant deduction. Budget papers estimate this will benefit 6.2 million workers with an average tax benefit of $205 a year, according to Budget 2026-27. Make a simple list of recurring legitimate expenses like uniforms, professional registration, or CPD and set a reminder to claim them each year. What good looks like? You consistently claim close to $1,000 if you incur it, worth around $200 plus a year with far less record keeping. Step 5 ties it together. Check your withholding. Because WATO is applied when you lodge your tax return, you may only feel the full benefit as a larger refund or a smaller bill after the year ends, unless the PAYG withholding tables are updated. So review your PAYG settings in ATO online once the 2027-28 rules are live. The point is to avoid the trap of either spending a phantom $250 you never receive in your pay or ignoring a benefit that only shows up a year later. Knowing the timing means you plan with real numbers, not assumptions. Here is why this matters over a working life. Take a mid-career nurse on $85,000, close to average full-time earnings, according to Treasury. If she ignores all this, she just gets a slightly bigger refund she spends without a plan, and her deliberate financial improvement is zero. But if she automatically directs around $2,000 a year, a conservative slice of the up to $2,116 benefit Treasury models, into her mortgage or investments at a modest 4% real return over 31 years, that compounds to roughly $140 each $100. To be clear, that is not a Treasury number. It is a straightforward compound interest illustration anchored on Treasury's annual benefit figure. The lesson: seeing this as just $250 could quietly cost over $100,000 of progress. Let me kill the most common mistake directly. The myth is that WATO is a $250 cash payment that just appears in your bank account like a bonus. The fact, according to Treasury and explanatory material, is that WATO is a tax offset, not a cash handout. It reduces your income tax liability by up to $250 a year if you earn income from work, applied when you lodge your 2027, 28, and later tax returns. It is a discount on your tax, not extra income, and for most eligible workers, it is automatically factored into your assessment rather than paid as a separate transfer. Plan around a smaller tax bill, not a new deposit. The second mistake is treating WATO as a standalone $250 and ignoring the stack around it. WATO sits alongside 3 legislated tax cuts and the $1,000 instant deduction. And for average earners, the combined benefit could be up to $2,116 a year from 2027 to 28, according to Treasury. If you do not factor that extra after-tax capacity into your budgeting, mortgage serviceability, savings goals, or wage negotiations, you leave thousands of dollars of effective take-home pay invisible. Over 10 years, an average earner who fails to capture roughly $2,116 a year in a structured way could forgo up to $28,000 to $160 before any investment returns, according to budget figures. Look at the whole package, not one line item. Quick recap. 1. Understand WATO is a tax offset that cuts your bill by up to $250, not a cash payment. 2. Log into MyGov and use the ATO calculator to find your real dollar saving. 3. Lock in where that money goes with an automatic transfer or extra super. 4. Simplify and claim the $1,000 instant deduction each year for around $205 in savings. 5. Check your PAYG timing and value the whole 5-measure stack, worth up to $2,116 a year for average earners. Do those and you turn a vague 250 headline into a real, repeatable financial gain. If this helped you make sense of the 250 to WATO and the bigger stack of tax cuts coming in 2026 and 2027, hit subscribe. We break down Australian tax and money rules in plain English so you can act on them, not just hear about them. Next up, watch our full guide on the $1,000 instant tax deduction and exactly which work expenses you can claim without receipts from 2026-27. Remember, this is general information only and not financial advice. Check your own situation with the ATO or a registered tax agent. I will see you in the next one.